Hey everyone, today I'm going to go over the types of adjusting journal entries that you would typically see in an introductory financial accounting course. The textbook that I'm using is the Corporate Financial Accounting 16th edition by Warren that is published by Cengage. So if you have a different textbook, you may have different types of accounts that you will see, but for the most part, everything is going to typically be the same. So I'm just going to go over some common journal entries that you would see in this type of a course. It typically is found in about chapter 3 of a financial accounting course, but it can vary again depending on the type of textbook that you are using. Okay, so let's go ahead and go through some of these. I have set up 5 of them here, so I'm going to go ahead and hit the problem. And you might hear my dogs crying in the background. That's just part of recording. So if you hear them, just ignore them. So on October 31st, the following data were accumulated to assist the accountant in preparing the adjusting entries for Meyer Corp. So let's go through these different types of business transactions that you would see that a typical accountant needs to make at the end of the period to bring their books up to date so that their financial statements can be prepared. Okay. So the first one is the supplies account balance on October 31st is $3,500. So showing in our books, we're showing a supplies of $3,500, but we do a physical count of the supplies on hand on October 31st, and we realize we only have $1,400 worth of supplies left. So we don't want to show in our books that we have $3,500 of supplies when we really don't. We only have $1,400. So we're going to go ahead and make our entry. So the first thing you want to do in a general journal is put in the date. So the date for this particular one is October 31st. So I'm going to go ahead and throw in my date here. Sorry, my dogs are distracting me. I hear them crying. They're looking out the window right now. So $3,500 is the amount that we said we have on hand. But in reality, again, we only have $1,400. So we're going to go ahead and make our journal entry to bring our books up to date. So as you know, when you make a supplies entry, whenever a company buys supplies, you're always going to debit supplies because anytime you debit an asset account like supplies, it goes up. Well, we need to bring our supplies account down and convert that now into an expense because anytime you use up the asset, it converts to an expense and you can show an expense on your income statement. So I have my chart of accounts listed down here and I want to figure out what type of expense account I need to debit. So anytime you debit an expense account, it goes up. You're increasing your expenses because you've now incurred an expense. So our supplies expense account is going to be debited here. So I'm going to go ahead and do that. And for the difference, so we want to know the amount we have used up. We started with $3,500. We're now down to $1,400. So that means we've used up $2,100 worth of supplies. And that is the amount you're going to use in your adjusting journal entry. It's always the amount that you have used up. So we're going to go ahead and debit the account for $2,100. And then we're going to credit our supplies account. Anytime you're making a journal entry in a general journal, the first line is always going to be a debit. The second line is going to be the credit. If you're only using, 2 accounts in this particular case, but always you start with your debits and then you put your credits. And in order to enter this as a credit, I'm not going to simply put it in here. I'm going to indent it. So I'm going to space over 3 spaces is what I typically like to do. And I'm going to put in supplies for the amount of my $2,100. So if I go back to my rules of entering or making journal entries, I want to say, do I at least have 1 debit and at least 1 credit? I do. I have a supplies expense debit and a supplies credit. Are they different accounts? So yes, because I have supplies expense and supplies. And do they balance? Do my debits equal my credits? So the reason why we indent our credits is because as an accountant is looking at a general journal, I don't want to have to go through and say, is this a debit? Is this a credit? If I'm looking over here, I know it's a credit because it's indented. So the credits are always indented to signify that you are crediting that particular account. And if I credit an asset account like supplies, it is going down. So I know that my supplies account is going down without there being a positive or a negative over here because when accounting first started, there was no such thing as negative numbers at that time, which is why we use debits and credits, and we've always stuck with that. It's just what we know. So all of my different rules, I have at least one debit, at least one credit, they balance, and they are two different accounts. So I'm good with that one. I'm going to move on to the next one. So my next adjusting entry says the unearned rent balance on October 31st is $4,000, and that is representing the receipt of an advance payment that we received on October 1st of 4 months rent from tenants. So we're renting out a piece of property, and they prepaid us money on October 1st of $4,000. So at that time, our original journal entry would have debited something in asset account like cash, and we would have credited something called unearned rent, because we can't put it as rent revenue until our tenant has used up that rent. So essentially until 1 month has passed. So we're now at October 31st, and 1 month of rent has actually been earned. So you cannot record revenue until it has been earned. So I'm going to go ahead and record my earned revenue now. So originally we would have credited unearned rent because it is a type of liability account. So I see under my liabilities, I have an account called unearned rent. So we had originally credited it to increase it because we credit a liability to increase it. So to decrease it, because now it is not a liability, it is now converted to revenue because I have earned that money, I'm going to decrease it by a debit. So unearned rent. And they prepaid us $4,000 representing 4 months rent. So that means it's $1,000 per month. So we haven't earned that full $4,000 yet until those 4 months have passed. We have earned 1 month of that. So 4,000 divided by 4 is $1,000. So we're going to go ahead and put $1,000 of rent that we have now earned. So anytime you're earning revenue, you can now go ahead and credit your revenue account. So to increase a revenue account, you credit it. So we're going to credit our account titled rent revenue. So I'm going to indent it to signify that it is a credit. Oops, not 100, 1,000. And so we'll go ahead and we're done with our journal entry here to make our accounts reflect the correct balances, essentially. So we've earned a month of rent. We can now record it as rent revenue, and that can be passed over to our income statement now when we post our entries. So, all right, let's go on to the third one. Wages accrued but not paid as of October 31st are $2,000. So the end of the month has passed. We're making our adjusting journal entries. Our workers have worked, but we haven't paid them yet, probably because the pay date has not come across yet. So we have a liability to our workers. We owe them money in the amount of $2,000, but we haven't paid them. So we can't hit cash because it's not being paid out as cash. We need to record a liability though. So they have earned that money. So we can record an expense, but we are not paying out cash yet. So we can't credit cash. We're crediting a payable account. So if we go down to our liabilities account, we have a wages payable in there. So we're going to go ahead and credit that instead of cash. So on October 31st, they have earned it, so we can now record an expense. So to increase our expenses, we need to debit them. So we do have an account called wages expense. So let's go ahead and put it in there. My spelling is terrible. I'm just warning you in advance. All right, so wages expense, $2,000. Again, we're not paying it out, so we're not going to credit cash. We're going to credit a liability because we owe it to our workers. So we have a wages payable. So if you look down in your liabilities section on your chart of account, we do have an account called wages payable. And we're going to credit that. So we have at least one debit, at least one credit. They balance, and they are two separate accounts. So we're done with that entry. Let's go ahead and look at the fourth one. Fees accrued but unbilled at October 31st are $14,000. So we have worked, or we have provided a service, and we can record a revenue. So our revenue is going to be fees earned. So that's, you credit revenue to increase your revenue. So we know what our credit's going to be, but we're wondering what our debit is because we haven't billed them yet, which means we haven't gotten paid. Anytime you have earned money but you haven't gotten paid yet, you're going to record an accounts receivable. So I abbreviated it down here in my chart of accounts just to save some space so I could fit everything on the same screen. But AR is typically accounts receivable. So I'm going to go ahead and put it up here. Anytime you increase an asset account like accounts receivable, you're going to debit it. I'm going to type out the account up here just so you guys don't get confused. But it is accounts receivable. So, oh, not supplies, accounts receivable. All right, so we have earned fees of $14,000, but we haven't gotten paid yet. So I'm going to go ahead and record that as a debit. I'm going to indent my credit, and my revenue account is going to be fees earned. Anytime it's a service business, typically it's going to be fees earned. Each company can have their own type of revenue account for this, but typically what you're going to see in an accounting course is going to be fees earned. All right, so let's move on to our last one. So you notice these are all as of the end of the month. Anytime you're doing adjusting journal entries, it'll typically be on one day of the month. Just a heads up on that. All right, our last one is depreciation of office equipment is $4,000. So your depreciation entries is the using up of a particular asset. So anytime you're buying an asset, like office equipment, you record it as an asset, but you can't record it as an expense on your books. So your income statement isn't showing that amount you paid out. Well, the accountants have recouped that type of expense under an account called depreciation. So the using up of the equipment. It's not a literal using up because the fair market value may be a little bit different from your depreciation, but it's a way to show an expense on the income statement because you have to record something expensive like office equipment, vehicles, buildings as an asset because it's something of value to the company. So the way to recoup that cost on your income statement is to depreciate particular assets. All right, so they're saying our depreciation for the office equipment for the month of October is $4,000. Anytime you're making a depreciation journal entry, an adjusting journal entry, you're always going to debit depreciation expense and you're always going to credit accumulated depreciation for that particular asset. So we do have an account called depreciation expense in our chart of accounts. And then again, I abbreviated down here, but this is accumulated depreciation for office equipment. So let's go ahead and debit our depreciation expense. They gave us the amount of depreciation, which is common in an introductory course. We will make you calculate depreciation as the semester goes along, but you're always going to credit your accumulated depreciation. And then we're going to signify what it is depreciating, I should say, office equipment here. All right, so I have at least one debit, at least one credit. They balance, and they are two different accounts. So your accumulated depreciation, just a little side note, is going to be listed on your balance sheet. So it is something called a contra asset account. Anytime it's a contra account, it behaves in the opposite way of whatever it's describing. So a contra asset behaves in the opposite way of an asset. So what that means is a typical asset, you debit it to increase it and you credit it to decrease it. A contra asset, however, behaves the opposite way. So to increase a contra asset, you actually credit it and you debit it to decrease it. So it behaves in the opposite way, but it is something called a contra account. So it's not a liability, it's not an equity, even though a credit will increase it. It's a contra asset account. So on your balance sheet, you'll show office equipment on there for the full value, and then underneath of it, it'll say less accumulated depreciation on the office equipment. So, and that amount will be subtracted from the purchase price of that asset, like this office equipment. So it'll show the net book value on your financial statement. And as you get into chapter 4, you'll see that more when you actually prepare your financial statement. So that's typically what comes after the adjusting chapter. So the adjusting journal entry chapter will be your posting and your closing entries, I should say, and your financial statement preparation. So you'll see how that is presented on the balance sheet once you get to that chapter. But right now, we just want you to be aware of the different types of accounts. So I hope you all have gained a lot from this video. Obviously, this isn't an extensive view of adjusting journal entries, but it'll see the typical types of journal entries that you will see in an adjusting journal entry chapter. Again, we're trying to bring our account balances up to date at the end of the month so that when we go to prepare our financial statements, we're showing the correct account balances in there. Okay, So hope you guys have learned a lot and you all have fun doing your adjusting journal entries, and comment below if you'd like to see any particular types of videos in the future. And I will see you all in parentheses. See you all later. Bye.